I was talking to my good friend who I'm going to introduce you to in a second. And what we recognize is that outside of even legal and identity theft, there are some financial resources that are available for the self-employed that I think most people are just not aware of. And right now, what I'm seeing happen in the business community is that there is a lot of businesses shutting their doors just because they're ill-prepared legally, financially. And I wanted to, when I was sitting down with Tim and we're just kind of going over some of the resources that are available to the self-employed, he shared a few with me. And I said, I need you in front of the room talking about what these resources that are available. Okay. This is not a PPLSI training, right? So this is not corporate. We're not selling you financial plans, but it is financial training and financial education because we want people to think. And I told Tim, one of the things that I see, especially amongst the self-employed, is that they only have the linear income plan in place. Like a lot of my friends, I have friends that are electricians, I have friends that are plumbers, I have massage therapists, that are tattoo artists. And the challenge is that if they get taken out of the game for whatever reason, their income stops. And they have to start thinking about other means that leverage income and that residual income as a part of their plan. And I'm going to share with you, again, some financial tools that are available to make sure. I need to raise this up. Okay. So I want to introduce you again, my good friend, Mr. Tim Hardy, to come up and share. So thank you very much, sir. The clicker is on and it is yours. So
I appreciate it. Good afternoon, everyone. Like Chris mentioned, my name is Timothy Hardy. For those of you I've not had the chance to meet, for those of you who are tuning in remotely, Chris and I have actually been good friends for 2-3 years now. We met doing a business owners development workshop mastermind group that both of us helped co-found, and had a lot of great conversations. By way of background, like Chris mentioned, I work in the financial industry. So I've been a financial professional for about 6 years, full equity partner with my firm, which is kind of a little bit accelerated. I was kind of on the accelerated track, which is very funny because by way of background, I had no financial education of any sort. I was a teacher for about 7 years. I taught all over the United States and a little bit internationally in Europe and East Asia. Absolutely loved it. Moved to Colorado, got a job offer at a national nonprofit. Very, very passionate about working with in the youth development community and nonprofit community, but then realized very, very quickly that without people in my age group stepping up to be the next big donors for those organizations, they were not going to last the test of time. I was basically a kid more or less fresh out of college, getting paid minimum wage to ask millionaires for money. I realized very quickly that wasn't where I wanted to be when we lost a couple of our big donors, and therefore a couple of what I would consider some of my biggest clients at the time. And I was like, well, who's going to step up and take their place so that we can actually continue serving our community and making an impact in a positive way in this world? One of my good friends, luckily for me at the time, reached out and said, hey, I know you want to get back into teaching. Have you ever thought about teaching people how money works? And now I stand here with you today, and we're about to have the most exciting conversation about taxes you have ever had. And most people, I usually get a big groan from the room when I say that. And I'm going to do my best to keep this under 30 minutes because I know there's a lot of information on the slides. I tried to keep it as simplistic as possible. I should have put the subtitle, Tax Ideas for the Self-Employed, subtitle, We Read the Tax and Job Cuts Act of 2017 so you wouldn't have to. And I'm realizing more and more when I encounter people in whatever industry they're in, and I mean, by show of hands, either on the Zoom or here in the room, how many of us would consider ourselves kind of subject matter experts in the areas that we work in, right? How many of us work with people that we would consider highly intelligent subject matter experts in the fields they work in, right? But even when I sit down with people, who have been brain surgeons for 25, 30 years, literally some of the best surgeons, doctors, heart doctors, whatever it is, rad doctors in the country, and I mean, by extension, in the world, and we're sitting down and having basic conversations about, hey, what is the tax structure, or what are some of the tax tools you're using in their business? And they're like, what? And I'm like, okay, let's start at the beginning. And so Chris and I had a couple of very long conversations, and I think originally our thought process was, how do we walk through maybe a holistic conversation around how people talk about money? And I decided that is way too boring for this conversation, but please feel free, kind of by way of background for Chris and I, when we first got together, my thought process was, hey, I'm not a licensed tax professional, and very, very small in the fine print down here. Please do not construe this as professional tax advice. Please consult your licensed tax professional because your tax situation might have changed in the next 30 minutes. It definitely will have. But bringing things to your attention that maybe you weren't aware of. And honestly, for most of the people in this room, I expect that you have seen the vast majority of what we're about to talk about in the next 30 minutes, but maybe just not in context of how it applies to you, how it applies to your friends, your families, other business owners that you work with, the people that you're having conversations with every day. And that's kind of where Chris and I came down. So for me, it's, hey, I have a lot of conversations with people about their financial well-being, about their financial planning. I mean, technically myself and my client service team work with everyone from individuals and families all the way up to small business owners, medium-sized business owners, and folks that run Fortune 500 companies. Really, our area of expertise recently has really been, especially through COVID, focusing on the essential needs and specific needs of small and medium-sized business owners to make sure that when they're working and when they're trying to develop their business, develop their career, their business is actually driving income and building their assets. And obviously by extension, their assets are actually getting them to where they want to be in the future. I'm not, by show of hands, how many people want to work until the day you die? Yeah, not a single hand in the room for you guys on the Zoom meeting, just so you're aware. And that's part of what this conversation is about, because I mean, Chris and I even talked about over tacos the other day, is so many business owners are only reinvesting their profits back into their company, not necessarily investing in themselves. So the first thing I want to talk about is really taking control of your business. And actually that font ended up being way smaller, my apologies, than I thought. I thought I did a good job of picking font size. I didn't realize how far back it would be sitting. But the first thing says, there are many things to balance when running a business. Does anyone want to shout out some of the things that you have to kind of keep in mind and balance when you're trying to run a business? Paying bills, payroll, absolutely, both for yourself as a business owner and for your employees. Other things. Training, yeah, and compliance, right? How do you train your compliant people to be compliant and also keep everyone trained for their effective job positions? Anything else? Liabilities, whether it's one, identifying the liabilities that you might have in your given industry, given company, but also then, again, making sure you're compliant with those liabilities and following all of the rules. And that's actually a great area where our relationship has been immensely beneficial for a lot of my clients, because again, I'm not a licensed tax professional, I'm not a tax attorney, right? And so when my clients have questions like that and they need professional advice, I'm like, awesome, have a great conversation with Chris, and you're gonna make sure you can get the actual, professional and legal advice you need at a fraction of the cost. Actually, in my office, I was lucky enough to get mentored by 3 of the top former international tax attorneys in the world from about 15 years ago, before they transitioned into the financial industry. The fourth guy in my office holds the record for the largest corporate tax deduction in history. For the sake of non-disclosures, I cannot say how much it was or what company it was for, but he's like a 35-year-old, but it's just crazy being able to have, rub shoulders with these type of people. But when my clients actually need the solutions, obviously, that have, the backing of licensure and law, they can talk to the attorneys they need to have a conversation with. Second thing is, how much does it cost to run your business? We talked about payroll, that's a big piece, but just operating costs, right? Whether it's marketing, whether it's travel, whether it's throwing marketing events like this or hosting training events. And that's actually something we're going to talk about a little later. But taking into account, what is the actual cost of running your business? And a pretty obvious follow-up question, would you like it to cost less? Not necessarily dollar amount, but making sure when you're incurring costs with your organization, with your businesses, or with the businesses that you work with, how can they make sure that they're getting every tax deduction that they can possibly, that's allowable for them to really bring up their bottom line and return more either assets to the company or more money into their pocket or the pockets of their employees. And finally, this is probably something that you guys have heard a bunch. Make sure to take time to work on your business, not just in your business. And I think to a certain extent, that's one of the big reasons we're having this conversation today, is how do we make sure that we don't just get so caught up in the, do a deal, close a deal, get a check, close a deal, get a check, but really, hey, how am I making sure in the event that I have employees in my organization that I'm training them to be just as good, if not better than I am in the future, but also building out the organization, kind of like Chris was talking about at the end of his presentation, to where it actually develops residual income for me into perpetuity without me having to constantly be there. Good transition, right? How many of you guys have seen the cash flow quadrant? Almost everyone in this room, or they're just not looking at the screen, so they're not sure what I'm talking about. And for those of you that are a little far away, it's a quick tic-tac-toe square with E for employees, S for self-employed, B for business owners, and I for investors. And a lot of folks have seen this. And the first question I always ask is, take a quick audit. Where are you in this quadrant, right? I'm sure a lot of us came from backgrounds where we worked in W-2 organizations, definitely as a teacher. And when I worked in nonprofits, I took a W-2 home, right? The organization told me how much I was allowed to make, regardless of how many hours I worked, since I was salaried, unfortunately. So getting paid minimum wage to ask millionaires for money definitely burned me out a little bit. And so I realized very quickly that maybe I wanted to move into the self-employed area where I got to make my own calendar and make my own decisions. The issue is, in the fine print, right, employees have a job, self-employed own a job, or maybe a better way of putting it is the job owns you, right? Because if you don't show up for work every day, how much money are you making? For the vast majority of people, it's absolutely zero, right? Depending on the industry we positioned ourselves in and the kind of services that we're adding for our clientele, right? The second question is, where do you want to be on this chart? And I don't know how many of you guys spend much time on social media. I try and spend as little as possible, but I recently started getting into Instagram because a couple of my friends tricked me into getting an account. And I realized there are a whole bunch of financial influencers, right? People that are like, oh, listen to my tips and trips and become a millionaire. And I'm like, okay, interesting, do tell. And so often they always just absolutely, polite words, disparage the people that sit in the employee bracket because they say, oh, you're controlled, you can only make as much as your company says you can make, blah, 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 blah. And I think one of the biggest things to realize is regardless where you sit in these brackets is as long as you can make your money work for you as an investor, it doesn't matter where else you are. Right? And that's a big piece because you want to make sure, again, that regardless of where your assets are coming from or your money is coming from, that money is working as hard to make more money for you as you work to get that money in the first place, right? Kind of got an amen. Third question is, you're welcome. I got one chuckle for the people on Zoom. What do you want your career and business to do for you? This is a question I ask a lot of my clients because I think too often, and just friends in general, is pretty much ever since we hit like 11 or 12, right? Our 11th or 12th birthday, people stopped asking us, oh, what do you want to do when you grow up, right? And we also stopped giving them actual answers like, I want to be an astronaut. I want to win, the Derby. Like, I want to go to space. I want to own a castle, whatever it is. Funnily enough, a few years ago when one of my mentors made me do like one of those goal picture chart things, you know what the top 2 pictures on my chart were? As a full-grown adult, the castle that I've picked out on the north coast of Scotland that I'm going to own one day, and a 10-day trip to the new International Space Station that they're going to be launching in 2027. Like, I realized when I actually thought about it, the exact same dreams I had as a kid are the dreams that I have today. And once I realized that and I understood, hey, where do I want to be in the future? I had a much better idea of where I need to sit on this list or on this chart to make sure that I could actually achieve those things in reality. The final question is, what changes do you need to make to be able to get where you want to go? Again, doesn't matter if you're pulling in a W-2, and especially for a lot of self-employed people, depending on how you have your organization structured per the tax code, you might be both the employee and, in that case, the business owner and an investor all at the same time. Or you might be running a sole proprietorship or an LLC, in which case you're self-employed. But if you're making your money work for you, you can be self-employed and investor and still effectively achieving your dreams. Or in the event that you're working with LegalShield or with another organization with a similar structure where you also have the opportunity to train more employees or more people under you to help replicate yourself and be a better version of yourself, and they're each a better version of yourself, they're all a level up from where you were when you started, then at the same time, you can combine any of those charts in any direction to make sure that you're moving effectively and with velocity, right? But, with the question of what changes do you need to make, Oh, so I may or may not, it may or may not have been very, very late, and I may or may not can neither confirm nor deny for legal reasons. Chris's drink of choice is generally Guinness around this time. Mine is probably Irish whiskey, and I cannot disclose how many drinks of it I had when I was preparing these slides, but I found this awesome picture. Does anyone know what these are? Macaroons? So I've also heard them pronounced macrons, macarones. Like the funny thing is, kind of back to the last slide, is similar to many things in the tax code, as well as many things in business. Most people don't know what the heck to call it or what the heck it actually is, right? And they don't know how to put the different solutions together to make it actually fit, which is why I thought that was a very, very tempting picture for me. Also because my wife makes those because she loves them, and I love them when she makes them because they're hella good and she's a great baker. Anyway, a few ideas. Again, please do not construe this as professional tax advice. Please consult your tax attorney through LegalShield. And if you don't have one, get LegalShield and then consult your tax attorney. But a few quick things that a lot of people haven't been aware of, and most of these have been available since the passage of the Tax Cut and Jobs Act of 2017. Numero uno, what is the difference, right? Consider the benefits of a tax status change. How many people are familiar with the difference between a pass-through organization and a corporation? No worries. So when we're thinking about tax structure for your business, most people are very, very familiar with sole proprietorships, which usually when you go into business for yourself, you just kind of are automatically a sole prop unless you file some different form. At that point, a lot of people are like, hey, you just went into business for yourself. Are you an LLC yet, a limited liability company? You probably should be because you want to, what? Limit your liability. Or you might be working together with friends, families, coworkers, whatever. And in that case, you might be a partnership, right? I'm not going to share my opinions on these different types of organizations, but for anyone that's ever had any sort of run-in with a enrolled agent or a CPA in Colorado, I'm sure you've heard them throw those terms around. On the corporation side, you also have what's called an S corporation or a C corporation. And the difference in those different filing statuses can have a massive effect on, one, the amount of taxes you are required to pay per the IRS guidelines, or the deductions you're allowed to take per the IRS guidelines. And just a key tip, this is a freebie. Regardless of what your opinions are, again, I will not share my personal opinions or political beliefs. The tax code technically is written so that we are legally obliged to pay as little in taxes as possible. And when you start looking at the tax code through that perspective, you're like, huh, that's interesting. Maybe I am paying too much in taxes. And to that I say, absolutely, we should fix that. So the first thing is corporation or tax through business. A lot of people don't realize if you're just a normal LLC, prop, or a partnership, the top individual tax rate, which some of you might already be familiar with, if you are paying taxes as an individual, which if it's a pass-through entity, you are, is 37%. What is the top corporate tax rate currently per the Tax Cut and Jobs Act? It's up there on the screen, 21%. Now, granted, there are other expenses and other fees you may have to pay as a corporation or corporate entity, but 16% is a pretty significant tax delta. Just something to think about, something you should be considering. But for those of you that might talk with your tax professional and get actual tax advice, please do. You might realize that maybe a pass-through entity is the better situation. And full disclosure, I only learned about this next part 3 days ago. Like I said, I read the Tax Act so you wouldn't have to. It still sucked. But I can say, again, this is not professional medical advice, but if you have issues falling asleep, read the tax code, you'll be out like a light. If you are a pass-through entity, you possibly have access to what's called the qualified business income tax deduction, which is a qualified deduction of up to 20% of your share of the business's income. Again, 20% is a pretty significant tax delta. Again, something to talk to your CPA about, sit down with your financial professional about. Finally, some other things that you guys are probably very, very aware of. Just possible tax deductions and savings, pretty much for any business owner, most of the time. If you receive any sort of 1099, you have a massive list of deductions that are potentially available to you. The ones that most people are familiar with are like, oh, you have to get your own health insurance, you can potentially deduct the premiums for that. A lot of people don't realize you can employ your child, get a tax deduction for the employment, and use that to fund their college or kickstart their retirement plans. So really you're like triple dipping as long as it's below the IRS maximum of $12,550, no income tax, plus it actually reduces your overall tax rate. So you get to reduce your taxes, get your kids income tax free, fund their college or retirement. It's pretty killer. And then like normal expenses, right? Whether it's training, continuing education, literature, organizational or training events, lunch and learns, things like that. Most of the time, those are qualified expenses. And I actually think the business expense for like business meals or client meals, they just changed it from 50 to 100% allowable deduction. Please confirm, but that's a big deal for 2022, all right? Going back up, how many people are familiar with the difference if you are a corporation and you pay yourself as the owner a W-2, do you also pay yourself with what's called a K-1? Anyone in the room? So there's a big thing, especially for corporate entities, S Corps and C Corps especially, is you are allowed to drop your overall income on your owner's W-2 to basically what the IRS calls, I think it's a reasonable salary. So like you work in the finance industry, I think like the national average is somewhere between $80,000 and $120,000 of income. So if I make $750,000 this next year, I can drop my W-2 down to, let's say, $150,000, because if I got injured or had to leave the business, that's about how much I'd have to salary someone to replace myself, technically according to the IRS. And the rest of my income, the other $600,000, I could shift over to a K-1 and potentially avoid a certain amount or mitigate or potentially defer a certain amount of those income taxes from this year to next year, or structured in a way so it either goes back into my business, goes into my savings, or goes into some of my retirement savings, long-term, short-term savings, so I don't pay the same amount of taxes I would have, because at $750,000, I would probably be at that top 37% tax rate. But if I drop my W-2 down, I could potentially mitigate that significantly. Another really cool one, this is one I love talking about. This is the other one that I just learned about 3 days ago, full disclosure. I am not the knower of all things there are to know, but I bring you these offerings of really cool things I just learned. Number one, home office deduction, the one that most people are familiar with. If you work not just in a brick and mortar office, but you also have space set aside in your house, if you pay, whatever, X number of dollars a month for your mortgage, you basically calculate the square footage of that office space. It does need to be used specifically for home office, or at least more than like 50% of the time, something like that. Again, please consult your CPA. You can deduct that amount off of your mortgage payments as a business expense. The two cool things I just learned, number one, if you are structured as an S Corp, and I think potentially as a C Corp as well, sorry, really quick before I go on with that. How many people in this room and on Zoom would like to make more than 6 figures in their business? Right? I'm assuming most of us have a goal to do that if we're not already doing it, right? If you're already making more than 6 figures, how many people would like to make multiple 6 figures or multiple 7 figures in this business? Again, please consult your licensed tax professional. Most of the time, what they would call the tax bright line, where it actually might serve you better for tax deductions, is usually around 6 figures. If you're grossing more than 6 figures, it might make sense to shift into an S corporation or a C corporation filing. And again, talk to your tax professional. But in the event you do that, and even for some people that make slightly less, it still might make sense. Number one, if you own a home and you're thinking about turning that home into a rental property, which Denver has a killer rental market, right? How many people have been thinking about, hey, maybe I should like move into an apartment and rent my house and I'd actually still be cash flowing more money, right? For the people that are considering doing that, you are allowed to sell your home to your S Corp, which does what? Number one, that resets, your deductible basis, depreciable basis. So let's say you bought your house, God knows how many months ago in debt for $250,000, right? And it's now worth $750,000, right? You also have what's called the homestead or home sale exclusion. So the home sale exclusion lets you, as an individual, basically preclude. Let's say, okay, $250,000, it's now $750,000. You can preclude $250,000 in the realized gain from that sale. If you're married, it's $500,000 because it's $250,000 for you and your spouse. So you could sell your $250,000 home to your S Corp for $750,000, deduct all of the $500,000 that you have of realized gains, which then resets your depreciable basis, and then you actually depreciate it through your S Corp, which flows through as an additional deduction on your personal tax filing. And you still own the freaking house. Nice. And then you could rent it and get rental income. Oh my gosh, it's freaking, I was so stoked when I found this out. The second thing, and okay, maybe you're like, I still want to live in my home. I don't want to rent it. I don't want to have to buy new properties or whatever. Cool. Did you know that you can actually rent your home up to 14 days a year for full market value to your S Corp for company events? Now, that does preclude entertainment, but anything like a corporate training, or for the people that have built out a sales force or a team where you have employees, you can do team trainings, company trainings. Really all you have to do is make sure it's at whatever the market rate is. So like, I don't know what this room would cost to normally rent out for an entire day, but assuming that you can fit this many people in your home, you can basically go and get the quotes for other places around town and then rent your home out to your S Corp, and then it ends up as tax-free income because it's a business freaking expense for up to 14 days a year. And I mean, my wife used to do corporate event planning, so I know spaces like this can cost anywhere from like a couple grand to 10 grand a day, depending on what you're doing. So that could be potentially, right, 10 grand to $150,000 of deductible expenses and tax-free income for your business, just for operating your business. Sorry, I'm getting too excited. Like I said, I used to be a teacher, so I'm just kind of getting like teacher mode here. And finally, the really exciting part for me, aside from those, what about retirement contributions? We're talking about make sure you're not just working in your business, you're working on your business. What are the actual cash flow from your business doing for you to get you closer to the work optional lifestyle that we all want, right? It's not, especially for a lot of us, because most of the people in this room, at least from the conversations I've had and listening to Chris, you guys all sound like you're actually passionate about what you do, right? You actually enjoy helping people. And most people, when they're doing something they actually love, right, and they feel like they're making a difference in people's lives, they don't just hit like 60 or 65 or whatever and just like hang it up and sit on the porch swing of life reading a newspaper for the rest of their life. They're like, no, I want to be involved in my community. I want to give back. But what you want that to look like is a work optional lifestyle. You only want to have to work on the things that you love doing. Otherwise, you want your money to just be making you more money, right? Cool. Just making sure we're on the same page, because otherwise the rest of this doesn't apply. Please log off and leave. Just kidding. So what are some of those savings tools that we need to make sure we have access to? And I kind of went in this is the one I love. Invest in yourself, not just your business. And Chris and I had a great conversation about this. What happens, right? Most people, there are plenty of people in Denver that are making incredibly profitable businesses. And then they're like, hey, maybe I want to sell my business, right? When would be a good time to sell my business? Hey, was 2020 a good time to sell your business? No. Was 2008 and 2009 a good time to sell your business, right? We don't have any control over the type of market that we're going to have to retire in, right? And so one of the biggest things is don't just put all your money back in your business and then kind of roll the dice on, hey, I'm going to sell my business and that's my business sale is going to fund my retirement. But if you end up accidentally having to retire during a 2020, or maybe you have to work 3 years or 4 years or another 5 years beyond when you wanted to, and you get burned out and your business performance suffers because of that, you don't want to be stuck in that situation, right? I apologize, I've gone way longer than I intended to. But we're thinking about savings tools. What are the things you're able to utilize? Number one on the list, how many people are familiar with traditional IRAs or Roth IRAs? Probably a lot of people right now. Does anyone know the maximum IRS contribution that you can make in a calendar year for those types of accounts? Answer is daily double, $6,000, right? $7,000 if you're over the age of 50 is catch-up contributions. Because of that, a lot of tax professionals, CPAs, maybe some you've talked to are like, oh, you start a business, you should open a simple IRA. Super easy to open, you can open it yourself, and you can contribute up to $13,500 a year. I mean, that's, twice as good as what you can do in a Roth IRA or traditional IRA, but it's still not very much. The vast majority of us, our dreams of retirement and the level of comfort and security we want to have in retirement probably isn't going to be funded with just $13,500 every single year. right? So what about a SEP IRA? That's usually the second suggestion you'll get from small business CPAs and tax professionals. SEP IRAs, you can contribute up to $61,000 a year or 25% of your annual earnings. So basically, if you don't earn at least $250,000 a year, you can't max fund that baby, which kind of sucks. But that's when you can potentially switch to solo 401ks or Roth solo 401ks. Same tax maximum up to $61,000 a year. The other cool thing is half of that is your employee contribution. The other half is the employer contribution. If you own your own business, you're freaking both. And your employer contributions, the whatever half of 61,000 is for the employer match, is tax deductible. That's awesome. If you have an organization built where you also have employees, probably want to go for a 401k, same matches, but you can also include your employees in on that and actually help them kickstart their retirement savings. So again, they're actually investing in themselves and not just the business, right? Ooh, defined benefit plans. This is a cool one. So you guys might see a theme, right? We're starting at the least amount of contributions and going down. How much do you guys think you can contribute to a defined benefit plan? Technically, as much as you want, I wish. Actually, there isn't technically a set number because it is based on an IRS calculation for your years of service and your income. But generally speaking, general rule of thumb, if you can contribute like 61 grand to these, most defined benefit plans is upwards of 300,000 in tax deductible contributions. Where you guys are going to be in your businesses in a couple of years, how many of you guys are definitely going to want a couple $100,000 in tax deductible contributions? All of us probably, right? And finally, deferred compensation and top hat plans, especially even if you are an individual owned business or you work in a business that has employees, right? Most of us in this room are probably going to be the highest compensated people in our respective businesses. Most of the time, is that true? So sometimes you need to make sure that you're actually having conversations about what a top hat program or deferred comp plan might look like for you. I have a very specific example of that. How many of us are college football fans in here? 2 of us, 3 of us, perfect. I don't know anything about college football. I'm Canadian, I like hockey. But I have something that you guys will really appreciate for those 3 people and whoever on the Zoom meeting is there. So, here we go. So usually when I say, hey, we're about to have the most exciting conversation about taxes you've ever had, this is the next thing I pull up. Most of you guys have seen the 3 different tax before. Most people are pretty familiar with these. Again, most of us just haven't seen them relative to each other and then had it applied to your situation. Number 1, most people are most familiar with the tax now bucket. Most of the stuff that's going to be in there is like your bank accounts, right? If you have any CDs at the bank, or if you open a Robinhood, an Acorn, your own brokerage account, you invest in mutual funds, stock, bonds, things like that. All of that sits in the tax now bucket, which all that means is every year, the growth on that bucket is taxed. And I don't have my little whiteboard, but normally it's like, if you think of like a parabola, right? You know, the market goes up, and then you have to pay the taxes, and it goes up, and you pay the taxes, and it goes up, and you pay the taxes. So it's always like 2 steps forward, 1 step back. Not that it's a bad place to save money, but especially as we're talking about mitigating the most taxes to make sure we're achieving our financial goals and making sure that we're doing it as efficiently as possible, probably the least efficient bucket, unless it's specifically short-term savings, like maybe an emergency fund, right, for your family or for your business. On the flip side, tax later and tax favored have one very, very important thing in common. That is tax deferred growth, which compared to tax now basically has a little parabola that just goes up and up and up, and you never pay taxes on it as long as those assets are in that bucket. But you guys are probably like, hey, that sounds pretty good. That's almost too good to be true, doesn't it? Well, the IRS is not exactly a charitable organization. They're going to get their money one way or another. The real question is, between these 2 buckets, when does the IRS ask for their money, and how much do you have to pay? And you guys have probably heard the analogy of the smart farmer before, right? Farmer goes to the store, buys a bag of seeds, plants his seeds. At the end of the season, he has a giant harvest. The IRS comes knocking and they're like, hey, you got to pay us your taxes, but we're going to let you decide how you'd like to pay them. So if you're the farmer, would you rather pay taxes on just the value of the bag of seeds or the value of the entire harvest? What would you say? Seeds. Bag of seeds. Not a trick question because it's always going to be a lower number. Tax favored is paying on the seeds. Tax later is paying on the harvest. Unfortunately, most people aren't aware, at least in my conversations, that they're allowed to pick where their money goes. Most of the time, by default, it's going to end up in the tax later bucket. That's why you see things like traditional IRAs or like a 401k, 403b, or normal 457 plan traditionally all sits in tax later. Or if you're one of the 4% of people that has a pension, congratulations, you're awesome, but also you're paying income tax on that forever in retirement. Conversely, if you strategically shift your assets over into the tax favored side, whether it's Roth solo 401ks or Roth 401ks, same thing normally, just shifted into the tax favored side. The big difference is how the money goes into the account. Over here, normally, whether you're getting paid W-2, your company or yourself, or 1099, normally your company deducts the money out of that, it goes into the account and then grows tax deferred. And then at the end of the account, you have to pay taxes on both the principal and the interest as you pull it out for income, right? Versus over here, you usually get paid whatever your paycheck is post-tax, or we pay it annually or quarterly as individual business owners, right? That's all considered after-tax dollars. We fund these accounts with after-tax dollars, grows tax deferred, and then as long as we follow the IRS guidelines, we never have to pay taxes again. So out of those three buckets, which one makes the most sense to defer or strategically eliminate the biggest tax liability over the course of our lives? Tax favored. Again, not supposed to be a trick question. So usually it probably behooves us to make sure we understand what we can use in that account, right? Pretty straightforward. Roth IRAs has a few pretty specific restrictions. Contribution restrictions, $6,000 a year. Income restrictions, you can't access it before 59.5 without taking a 10% tax penalty. That is also true of traditional IRAs, 401ks, and Roth 401ks, which should have been on that list. I'm going to fire my secretary. I made that list. It was me. So I'm fired. So really great tool, probably not going to fully fund your retirement. Municipal bonds, great tool, really expensive to get into, don't really grow much, very, very safe. So they're great if you're like budging right up against retirement, you want to protect your assets. But generally speaking, for most of us, when we're in the asset accumulation phase, not the best tool for the moment. You might notice that aside from the 401k that should be over, the Roth 401k that should be over there, the only other three things in that bucket are different types of permanent life insurance. And you might be asking yourself, hey, Tim, I thought we were just talking about saving for retirement. Why are we talking about life insurance all of a sudden? That is a great question. I'm so glad you guys asked. Coming back to who is the most successful and potentially highest compensated college football coach of all time? I don't, but I know two names for the purpose of this example. Generally people say Nick Saban, right? Incredibly successful Alabama football coach. Incredibly, he's been around forever, won so many championships. People are like, oh, obviously Nick Saban is the most highly compensated. Actually, the most highly compensated coach is Jim Harbaugh over at Michigan. Why is that? That's because when Jim, 2 years ago, I think, was looking at leaving college football and going back to the NFL, right? Getting a real boy job. Michigan was like, hey, wait a minute. Why don't we put together a deferred comp plan for you that defers $2 million a year of your income, of your contract, into a permanent life insurance policy for the next 7 years. Deferred comp plans and top hat plans are one of the best ways to find, retain, and motivate highly compensated and high performers in your company. And if you are that person, for your company, why the F aren't you attracting, motivating, and retaining yourself? Because you freaking should be. They were doing $2 million a year for 7 years. Now, you don't necessarily have to put that much in there, but you can. And a big difference when we're talking about permanent life insurance, it actually comes under section 7702 of the tax code. How many people are familiar? No one. That's right. And you should be. Why? What did I say the specific IRS limitations on retirement plans were? Contribution limitations, access restrictions, and technically also income restrictions. If you make more than a certain amount, you're not allowed to put into some of the tax favored accounts. Because 7702 does not come under retirement accounts, it's technically life insurance per the IRS. It doesn't have any contribution restrictions, access restrictions or income restrictions. So it can be a massively beneficial tool, especially for highly compensated individuals, or even just people normally working their jobs that want to have the best tax positioning possible. And it also makes sure you're covered, your family's covered, and your business is covered in the event of a catastrophic liability. So we're talking about work optional lifestyle. What does it look like for you? And if you guys can't see, there's a cute little cat on here. Again, it was very late when I made these slides and I saw that and I was like, oh, it's so adorable. And I had been, I can neither confirm nor deny whether or not I was drinking Jameson. But what does work optional lifestyle look like for you, right? We were talking about it earlier. Take a quick audit. Where are you now? Where do you want to be? And are you using those tools effectively, whether it's making sure that your company is filing in the correct position that it should be, so you're accessing all of the deductions that you deserve and the IRS has set aside specifically for you to take advantage of, so that you can continue adding the best service to both your clients, but also laying the foundation for a secure retirement the way you want it to be. Any questions, guys? We have like 3 minutes. Yes. Oh, yes. Microphone.
Okay, I had just a curiosity question for the coach who had the school putting $2 million a year.
Mm-hmm.
So when he retires, he takes advantage of the cash value. That's where his money comes in, right?
Mm-hmm.
And because it's insurance, that money is actually tax-free.
Correct.
So if he had taken it as a real salary, the $2 million, he'd have been taxed on the $2 million, but because he doesn't take it out, when he does take it out as cash value, 100% of that money, cash value, is tax-free.
Absolutely. And depending on how he accesses it, that is true. And one thing to be very aware of is tax later, because it's pre-tax dollars funding it, the company, your company, whatever company, gets a tax deduction for funding into these types of accounts. They do not get a tax deduction for funding into these types of accounts. But depending on when your retirement date is, the amount of tax that you avoid, right? How many people think they're going to be making more money in the future and have more assets? Generally speaking, does your tax rate go up when you make more money and have more assets, right? So it's a balance, and that's why we talk to tax experts. In that situation, it made sense, especially for the university, to retain him. They didn't get the tax deduction for funding his deferred comp plan through the life insurance, but they get to keep him as a coach for 7 years, which is a massive, massive benefit for them.
You're the boosters paid for the $2 million. Anyway.
Yeah, right. Exactly.
Are you Hello. Oh, hi. Are you related to Paul Harvey?
Paul Harvey, I am not. People always ask me if I'm related to Tom Hardy, the actor. Absolutely.
Okay. Have you
Twins.
seen
They were
anything as a deduction relating to wellness? Not your health insurance, but wellness.
Yes, I have. I'm not sure if it was specifically addressed in the 2017 Tax Cuts and Jobs Act. My understanding was there was an allowable company contribution for employees. I do not know what that specific number was or if that is still available. Please consult your professional tax person.
Well, I did.
Perfect.
And she doesn't have the right answer.
Awesome.
In my opinion.
Awesome. Then please see my tax professional. And that's another thing, guys, is like tax professionals, tax professionals, Chris, like we're all fallible, right? None of us are infallible. And in the same way that I have the friend who's like, he's like, I have the record for the largest corporate tax deduction ever. I'm like, awesome. Do you know what like the maximum I can put in to my solo 401k? He's like, nope, but I'll find the answer. And that's the biggest thing, is just make sure you're working with professionals that will admit that they don't know stuff. All the time. I don't know anything. That's why I wrote down all these notes. But no, that is a great question. I do need to look into that, because I was just chatting with my wife about doing like getting back into the gym now that they're opening after COVID, and kind of doing a fitness program again, because I got a little bit tubby.
Because that's a big
Eating cake.
It's a big push for employers is wellness. And so if you are an employee of your company, then how can you take advantage of that.
Yeah.
You know?
Oh, yeah, absolutely. And that's a huge piece. And I guess one of the other things that I forgot to mention, Chris forgot to mention it, we'll just say that, is when Chris and I first started working together, part of our agreement was my team will sit down with any business owners or any of their employees at no cost to the company. Normally that's about a $50,000 annual retainer for a team like mine to offer those services. But again, I mean, I come from a teaching background, right? And I actually have the books for anyone that wants one. Our firm came out with the How Money Works books about, it was right before COVID, so end of 2019. In my mind, I want to be an educator, right? Regardless of whether people sit down with me and actually, you know, walk through financial strategies or close any business, I don't really care because I know they're going to be better off for having sat down and have a conversation. Even if I just give someone a book and never talk to them again, they never reach out to me, I know they're going to be better off for the information in that book. So that's a big thing that I offer to Chris. Any of the folks he works with, any of you guys with LegalShield, even if you're not necessarily technically connected yet, we always offer our services at no cost. Because we want people to be in a better position moving forward. Thank you guys so much. I will